What if I told you that wealth isn't created by hard work, smart investments, or brilliant ideas? What if the entire system is rigged so that a select few institutions get access to newly created money before it enters the economy, allowing them to buy assets cheap and sell expensive while your savings get destroyed by the inflation they caused? Here is the thing they'll never teach you in school. The Federal Reserve doesn't just print money and hand it out equally. They give it to 24 hand-picked institutions, primary dealers, who get to borrow billions at near zero interest rates. These banks and hedge funds take that free money, buy stocks, bonds, real estate, and commodities, and watch their wealth explode. By the time that money reaches you in the form of wages or loans, prices have already inflated. You're earning the same dollars, but everything costs more. You're not poor because you're lazy. You're poor because you're last in line for the money. Think about your own life. Your salary barely keeps up with rent. Groceries cost more every month. Meanwhile, billionaires got $2.1 trillion richer during COVID, while you got a $1,200 check. Ever wonder how that's possible? It's because they have access to the money creation system. You don't. Before we go deeper, drop a comment. Where are you watching from? And do you know what a primary dealer is? Because this story will show you exactly how the wealthy stay wealthy while you stay broke. Hit that subscribe button for the unfiltered truth about the money pipeline. Let's start in 1913, the year they built the machine. In 1913, Congress passed the Federal Reserve Act, creating the central banking system of the United States. The official story? The Fed was created to stabilize the economy, prevent bank runs, and manage monetary policy for the public good. The reality? The Fed was created by and for banks to ensure they'd never fail, never face consequences, and always have access to unlimited liquidity. Here's how it works. The Federal Reserve is a central bank. It has the power to create money out of nothing, but it doesn't give that money directly to the government or to citizens. It gives it to banks. Specifically, it gives it to primary dealers, a select group of 24 financial institutions authorized to trade directly with the Federal Reserve. These primary dealers include JP Morgan Chase, Goldman Sachs, Citigroup, Bank of America, Barclays, Deutsche Bank, and Morgan Stanley. You get the picture. The biggest banks on Wall Street. When the Fed wants to stimulate the economy, it doesn't send checks to citizens, except in rare cases like COVID. It creates money and uses it to buy bonds from primary dealers. Here's the sequence. First, the Fed creates $100 billion digitally. Second, the Fed buys bonds from JP Morgan at inflated prices. Third, JP Morgan now has $100 billion in fresh cash. Fourth, JP Morgan uses that cash to buy stocks, real estate, corporate bonds assets that will appreciate. Fifth, asset prices rise. JP Morgan profits. Sixth, the new money eventually trickles into the broader economy as higher prices. By the time you see the money, it's already been used to inflate asset prices you can't afford. Sound familiar? Because this is the exact mechanism that's been running since 2008. Quantitative easing, zero interest rates, repo market operations, it's all the same system. The Fed prints money, gives it to Wall Street, and Wall Street gets richer. Let's look at the numbers. Between 2008 and 2022, the Federal Reserve's balance sheet expanded from $800 billion to over $9 trillion. That's $8.2 trillion in newly created money. Where did it go? Not to workers. Real wages have been stagnant since the 1970s. Not to small businesses. Over 200,000 closed during COVID. It went to asset owners. The stock market tripled. Real estate prices doubled. Billionaire wealth increased by 70%. Sound familiar? Because this is the same structure as feudalism. The king, the Fed, grants land money to the lord's primary dealers who extract wealth from the peasants and pay tribute back to the king. You work, they profit, the system extracts. But here's the part they really don't want you to know. This isn't just about quantitative easing or low interest rates. It's about access. Primary dealers have access to the Fed's discount window, a lending facility where they can borrow unlimited amounts at ultra-low rates. During the 2008 crisis, the Fed lent out $16 trillion in secret loans to banks, hedge funds, and even foreign institutions. This wasn't revealed until a 2011 audit forced by Senator Bernie Sanders. $16 trillion, secretly, to Wall Street. While homeowners were foreclosed on and lost $16 trillion in household wealth, banks were getting secret bailouts 100 times larger. Sound familiar? Because this happened again in 2020. When COVID hit, the Fed didn't just cut rates to zero and opened unlimited lending facilities for banks, bought corporate bonds, backstopped money market funds, and essentially nationalized credit markets. The stock market crashed in March 2020. By June, it was at all-time highs. How? Free money for Wall Street. Meanwhile, 20 million Americans were unemployed. but the stock market, owned overwhelmingly by the wealthy, hit record highs. This is the Cantillon effect in action. Richard Cantillon, an 18th century economist, observed that when new money enters an economy, it doesn't spread evenly. The people closest to the source of money creation benefit first. By the time it reaches the general population, prices have already risen. Modern central banking is the Cantillon effect on steroids. The Fed prints money. Wall Street gets it first. They buy assets. Prices rise. You earn wages in the same dollars, but everything costs more. You re-getting poorer in real terms while they re-getting richer, using money that was created from nothing. And it's perfectly legal. It's policy. Here's the kicker. You can't access this system. You can't borrow from the Fed at 0%. You can't buy bonds and flip them for profit. You can't call up the discount window and ask for $10 billion. But JP Morgan can. Goldman Sachs can. Citadel can. This is the hidden system that decides who gets rich. Not merit. Not innovation. Not hard work. Proximity to the money printer. And the people with that proximity? They've had it for over a century. So who actually controls this system? Who decides which 24 institutions get to be primary dealers? The Federal Reserve Bank of New York. Not Congress. Not the president. Not voters. A private institution owned by member banks decides who gets access to the most powerful wealth creation machine in history. And here's the insane part. The same banks that are primary dealers own the Federal Reserve regional banks. Let me say that again. JP Morgan, Citigroup, and Bank of America are primary dealers, meaning they get to borrow unlimited money from the Fed at near zero rates. And those same banks are shareholders in the Federal Reserve regional banks that set the policy and manage the lending. They own the casino, and they're the biggest players at the table. This is the ultimate conflict of interest. And it's baked into the structure. The Federal Reserve Act of 1913 mandated that the Fed be owned by private member banks. It's not a government agency. It's a quasi-private institution with government-granted monopoly power over money creation. And the banks that own it get first access to the money they help create. This isn't capitalism. This is a private money cartel with legal monopoly status. But it gets darker. During every financial crisis in 1987, 2000, 2008, 2020, the Fed's response is the same. Cut interest rates to zero. Print trillions of dollars. Lend it to the same institutions that caused the crisis. Let them buy assets at fire sale prices. Inflate asset prices back to record highs. The banks profit. The public pays. In 2008, banks got bailed out. Executives got bonuses. Homeowners got foreclosed. In 2020, banks got unlimited liquidity. The stock market soared. Workers got $1,200 and unemployment. The pattern is clear. The Fed exists to protect the banks, not the public. And the mechanism that enables this? Primary dealer access. If you're not one of the 24, you don't get to play. You don't get the free money. You don't get to buy assets before inflation. You don't get rich. You just get the bill. But who actually designed this system? Who set it up so that banks would have permanent access to free money while citizens get debt and inflation? You won't believe the names. And the receipt is wilder than you think. Let us break down exactly how the money pipeline works and why access to it is the only thing that matters for building wealth. Mechanism 1. Primary dealer privilege and the discount window. Primary dealers are financial institutions authorized by the Federal Reserve Bank of New York to trade government securities directly with the Fed. This sounds technical, but here's what it really means. When the Fed wants to inject money into the economy, it buys treasury bonds and mortgage-backed securities from primary dealers. The dealers get cash, instantly, at whatever price the Fed sets. This creates a risk-free profit mechanism. Here's how it works. The U.S. Treasury issues $100 billion in bonds. Primary dealers buy them at auction. The Fed immediately buys those bonds from the dealers at a slightly higher price. The dealers profit on the spread, sometimes billions with zero risk. But that's just the beginning. Primary dealers also have access to the Fed's discount window, a lending facility where they can borrow money at ultra-low rates to finance anything they want. During the 2008 crisis, the Fed opened emergency lending facilities that allowed primary dealers to borrow trillions at rates as low as 0.25%. They took that money and bought stocks. The S&P 500 tripled from 2009 to 2021. Real estate prices doubled in many markets. Corporate bonds yields compressed. Prices soared. Commodities, gold, oil, everything inflated. By 2010, Wall Street was back to record profits, record bonuses, record wealth. Homeowners? Still underwater. Unemployment? Still 9%. This is wealth creation by proximity, not by work. By access. Mechanism 2. Repo market and overnight lending. Here's a mechanism most people have never heard of, the repo market. Repo stands for repurchase agreement. It's how banks and hedge funds borrow money overnight using securities as collateral. The repo market processes $4 to $5 trillion daily. That's more than the GDP of Japan. Every single day. And guess who has access to the Fed's repo facilities? Primary dealers and a select group of institutional investors. Here's how it works. A hedge fund owns $1 billion in treasury bonds. They sell those bonds to the Fed with an agreement to buy them back tomorrow. The Fed gives them $1 billion in cash overnight. The hedge fund uses that cash to buy more assets, make leverage bets, whatever. The next day, they buy the bonds back for $1 billion plus 0.05% interest. They just borrowed $1 billion at 0.05% annual interest. You can't do that. Your mortgage is 7%. Your credit card is 22%. Your car loan is 9%. But if you're a primary dealer or a connected hedge fund, you can borrow billions at 0.05%. This is the leverage machine that allows Wall Street to multiply wealth exponentially. And when it breaks like it did in September 2019, when repo rates spiked to 10%, the Fed steps in and provides unlimited liquidity to stabilize the system. They'll never let it fail, because the people who would lose are the people who own the system. Mechanism 3. The Cantillon effect and asset price inflation. Let's talk about what happens when all this newly created money enters the economy. The Cantillon effect explains it perfectly. New money doesn't spread evenly. It flows through specific channels. The people closest to those channels benefit first. Here's the modern flow. Fed creates $1 trillion digitally, instantly. Fed buys bonds from JP Morgan, Goldman Sachs, etc. Those banks now have $1 trillion in cash. They invested in assets, stocks, real estate, private equity, venture capital. Asset prices rise. Wealthy people who own assets get wealthier. The new money eventually reaches workers as wages if they're lucky. But by then, prices have risen. Rent is higher. Food costs more. Healthcare is more expensive. The wealthy get the money when it's worth the most. You get it when it's worth the least. This is why wealth inequality has exploded since 2008. The top 1% own over 50% of all stocks. The top 10% own 89% of all stocks. When the Fed prints $9 trillion and injects it into financial markets, who benefits? The people who own financial assets. The top 10%. The people with access. Everyone else gets inflation. Let's look at the numbers. From 2008 to 2020, the Fed balance sheet went from $800 billion to $7 trillion. The S&P 500 went from 683 in March 2009 to 3,800 pre-COVID 2020. Over 400% gain. Real wages for workers? Up 11% over the same period. Adjusted for real inflation, housing, healthcare, education? Probably flat or negative. The wealth went to asset owners. The inflation went to everyone else. Mechanism 4. Too big to fail and moral hazard. Here's the ultimate scam. If you're a primary dealer or a systemically important financial institution, you can take infinite risk because the Fed will always bail you out. This is called moral hazard. When someone is insulated from the consequences of their actions, they act recklessly. Let's look at the track record. 1998. Long-term capital management, a hedge fund nearly collapsed. The Fed organized a bailout. 2008. Bear Stearns, Lehman Brothers, AIG, Citigroup, Bank of America all collapsed or nearly collapsed. The Fed and Treasury bailed them out with $700 billion in TARP, plus $16 trillion in secret loans. 2020. Entire markets froze. The Fed stepped in with $4.5 trillion in liquidity, corporate bond purchases, and unlimited repo operations. Every time, the same institutions get saved, and every time, they profit. Because they know the rules. Privatize profits, socialize losses. If your bet works, you keep the gains. If your bet fails, the taxpayer via the Fed covers the loss. This isn't capitalism. This is a stake-backed casino where only insiders get to play, and the house always covers their losses. Mechanism 5. Information asymmetry and insider networks. Here is something most people don't think about. Access to the Fed as money pipeline comes with access to information. Primary dealers know when the Fed is going to cut rates before the public. How much liquidity will be injected before the public? Which assets the Fed will buy before the public? What the Fed's internal models predict before the public. This is information asymmetry, and it's worth billions. If you know the Fed is about to cut rates and inject $500 billion, you buy assets before the announcement. When the Fed acts, prices surge, and you profit. Retail investors find out when CNBC reports it. By then, it's priced in. This is why Wall Street traders consistently outperform the market. Not because they're smarter, because they have access. They're playing with insider information, legal insider information, that gives them an edge over everyone else. Mechanism 6. The revolving door and regulatory capture. Let's not forget who runs the Fed and who becomes primary dealers. Treasury secretaries, Fed governors, and SEC chairs almost always come from and return to Wall Street. Hank Paulson, Goldman Sachs CEO, then Treasury Secretary, then orchestrated bailouts that saved Goldman. Timothy Geithner, New York Fed President, then Treasury Secretary, then joined a private equity firm. Janet Yellen, Fed Chair, then made $7.2 million in Wall Street speaking fees, then Treasury Secretary. Jerome Powell, private equity, then Fed Chair. The people who decide who gets access to the money are the same people who came from and will return to the institutions that benefit. This is regulatory capture. The industry controls the regulators. And the result? The system is designed to serve the industry, not the public. Mechanism 7. Why you can't access the system. Here's the brutal reality. You will never be a primary dealer. You will never borrow from the Fed's discount window. You will never get $1 billion in overnight repo financing at 0.05%. You're locked out. The only access you have is through a job taxed at 20 to 40%. A savings account earning 0.5 to 4%, losing value to inflation. A 401k feeding fees to Wall Street managers who are primary dealers. A mortgage paying 7% interest while banks borrow at 0.25%. Every avenue available to you is designed to extract wealth, not build it. Meanwhile, the people with access to the money pipeline multiply their wealth exponentially. This is the hidden system that decides who gets rich. Not talent, not effort, not ideas, access. So where does this leave us? The system is accelerating. The Fed's balance sheet is still over $7 trillion. Interest rates are elevated, but will drop again the moment markets crack. And when they do, the same 24 institutions will get the money first. They'll buy the assets. They'll profit from the crisis. And you'll get the inflation. This isn't a bug. It's the core architecture. The Federal Reserve was designed to protect banks, not people. Primary dealer access was designed to ensure Wall Street always has liquidity. The discount window, repo market, and quantitative easing programs exist to guarantee the connected institutions never fail. And as long as this system exists, wealth will concentrate. The top 1% will own more. The bottom 90% will own less, not because of merit, because of access. Here's the final brutal truth. The American dream is dead, not because people stopped working hard, but because the system rewards proximity to the money printer, not productivity. You can work 80 hours a week. You can save diligently. You can invest wisely. But if you re-not in the network, if you don't have access to the Fed's money pipeline, you'll always be playing catch-up to people who do. This is financial feudalism. The lords have access. The serfs get wages. And the system extracts. The lesson here isn't despair. It's clarity. You can't change the system, but you can stop pretending it's fair. You can stop believing wealth is meritocratic. You can stop blaming yourself for a rigged game. And you can build wealth outside the system through skills, businesses, real assets, relationships. So I'll leave you with this. Are we wiser now? Or are we just better-dressed peasants in a monetary empire? Drop your thoughts below. Subscribe if this opened your eyes. Share this with anyone who still believes hard work alone creates wealth. The truth doesn't need access. But we do.